I've been doing this for over 60 years. I've made billions of dollars betting against conventional wisdom. I've taken on some of the biggest corporations in America and won. And right now, I am doing something that should make every investor pay very close attention. I am quietly exiting growth stocks, not trimming, not rebalancing, exiting. And if you understand why I am doing this, you might save yourself from one of the most painful lessons the market is about to teach. Let me be very clear about something from the start. I am not a perma-bear. I am not someone who sees doom around every corner. I've made most of my fortune by being an optimist about American business, by believing that companies can be fixed, that value can be unlocked, that the market eventually recognizes quality. But I've also survived in this business for 6 decades because I know when to step aside. I know when the risk-reward no longer makes sense. And right now, the risk-reward in growth stocks is as bad as I've seen it in my entire career. Let me take you back to a moment that shaped how I think about these situations. It was 1999. The internet bubble was in full swing. Everyone was getting rich on technology stocks. Companies with no earnings, no revenue, sometimes no actual product were trading at valuations that made no mathematical sense. I was at a dinner party in Manhattan surrounded by hedge fund managers and investment bankers. And every single one of them was talking about how the old rules didn't apply anymore. They said the earnings didn't matter. They said cash flow was irrelevant. They said the internet had changed everything and traditional valuation metrics were obsolete. I remember sitting there listening to these supposedly brilliant people explain why a company losing $100 million a year was worth $10 billion. And I felt like I was taking crazy pills. These weren't stupid people. These were some of the smartest financial minds in the country. But they had convinced themselves that gravity no longer applied, that what goes up doesn't have to come down, that trees really can grow to the sky. One of the most respected hedge fund managers at that party, a guy who managed billions of dollars, told me I simply didn't understand the new paradigm. He said the old way of valuing companies was dead. He said I was a dinosaur, a relic of a bygone era. He was so confident, so absolutely certain that he was right and I was wrong. And you know what? 6 months later, his fund had lost 70%. He never recovered. Last I heard, he was consulting for small companies trying to rebuild his reputation. I sold almost everything that night, not the next day. That night, I went home and started placing orders to exit my technology positions. My partners thought I was insane. My investors were furious. For the next 6 months, I watched the NASDAQ climb another 40%. While I sat on cash earning nothing, I looked like an idiot. People whispered that Icahn had lost his touch, that the old corporate raider didn't understand the new economy. Then March of 2000 happened, the bubble burst. The NASDAQ crashed nearly 80% from its peak. Companies that were worth billions became worthless. Trillions of dollars in wealth evaporated. All those smart people at that dinner party, they lost everything. Some of them never recovered. Some of them are still trying to dig out from the financial and psychological damage of that crash 25 years later. I tell you this story not to brag about being right. I tell you because I am seeing the exact same patterns today. The same overconfidence, the same dismissal of traditional metrics, the same belief that certain stocks can only go up. And I am responding the same way I did back then. I am getting out. Now let me explain my framework for understanding when growth stocks become dangerous. Because this isn't about being negative on innovation or technology. I love innovation. I've made enormous amounts of money investing in companies that transform their industries. But there is a difference between investing in innovation and speculating on stories. And right now, most growth stock investors are speculating on stories. Here is how I think about it. Every investment ultimately comes down to one question. What is this business actually worth? Not what the stock price says it is worth. Not what other investors think it is worth. What is the underlying business actually worth based on the cash it generates, the assets it owns, and the growth it can reasonably achieve? For most of my career, this question had a relatively straightforward answer. You looked at earnings, you looked at cash flow, you looked at book value, you applied a reasonable multiple based on growth prospects and competitive position, and you compared the result to the stock price. If the stock was trading well below your estimate of intrinsic value, you bought. If it was trading well above, you sold or you stayed away. But in recent years, something strange has happened. A large portion of the market has simply abandoned this framework entirely. They've replaced fundamental analysis with narrative analysis. They don't ask, what is this business worth? They ask, what is the story that could make this stock go higher? And look, I understand the appeal. Stories are exciting. Stories can come true. And when they do, the returns can be spectacular. If you bought Amazon in the early 2000s when everyone thought it would fail, you made 100 times your money. If you bought a Tesla before it proved electric vehicles could work, you made even more. These stories came true, and the early believers got rich. But here is what most people don't understand. For every Amazon that succeeded, there were 100 internet retailers that failed. For every Tesla that made it, there were dozens of electric vehicle companies that went bankrupt. The survivors are visible, the failures are forgotten, and this creates a massive survivorship bias that distorts how people think about growth investing. I remember in 2001 walking through a tech conference and seeing booth after booth of companies that investors had poured billions into: online pet supplies, grocery delivery, social networking before it was called that. Every single one of those companies had believers who were certain they were backing the next Amazon. Every single one of them had pitch decks projecting hockey stick growth. And almost every single one of them went to zero. The investors lost everything, but nobody talks about them now. We only remember the winners. When I look at the growth stock universe today, I see a lot of companies trading on stories that have very low probabilities of coming true. Companies with no profits trading at valuations that assume they'll become the dominant player in their industry. Companies losing billions of dollars per year with no clear path to profitability. Companies whose business models depend on conditions that may never materialize. And the worst part is, even if some of these stories do come true, the stocks are already priced for perfection. There is no margin of safety, no room for error. Everything has to go exactly right for investors to make money. And in my experience, things rarely go exactly right. Let me get specific about what I am seeing and why I am getting out. The first major concern is valuation compression. For the past 15 years, growth stocks have benefited from a historic expansion in valuation multiples. Companies that used to trade at 20 times earnings started trading at 40 times. Companies at 40 times went to 60 times, and some companies with no earnings at all achieved valuations that made no sense by any historical standard. This multiple expansion was driven primarily by one thing: low interest rates when money is essentially free. When you can borrow at 0%, future cash flows become extremely valuable. A dollar earned 10 years from now is almost as valuable as a dollar earned today when discount rates are near zero. This mathematics justified higher and higher multiples for growth companies. But that era is over. Interest rates have normalized. The Federal Reserve has made clear that 0% rates are not coming back anytime soon. And as rates stay elevated, those mathematical justifications for extreme multiples evaporate. Think about what this means practically. A company that was worth 100 times earnings when rates were zero might only be worth 50 times earnings when rates are 5%. That is not because the business got worse. It is just math. The present value of future cash flows is lower when discount rates are higher, and we're only in the early stages of this adjustment. I've watched this movie before. In the early 1980s, after Paul Volcker raised rates to crush inflation, growth stocks went through a brutal period of multiple compression. Great companies with growing earnings saw their stock prices cut in half because the multiple contracted faster than earnings grew. Investors who bought at the wrong time waited years, sometimes a decade, to break even. The same thing happened after the 2000 bubble. Microsoft was one of the best businesses in the world. Its earnings grew throughout the 2000s, but the stock went nowhere for over a decade because the multiple had to compress from bubble levels to reasonable levels. Investors who bought Microsoft at the peak in 1999 didn't make their money back until 2016, 17 years of dead money in one of the greatest businesses ever created. This is what happens when you buy growth stocks at extreme valuations. Even if the company executes perfectly, even if earnings grow substantially, you can still lose money or make nothing for extended periods because the multiple compression overwhelms the earnings growth. Let me tell you another story that illustrates this point. In the late 1960s, there was a phenomenon called the Nifty 50. These were 50 large cap growth stocks that Wall Street decided were so wonderful, so dominant, that you could buy them at any price and hold them forever. Xerox, Polaroid, Avon, Kodak, these were the Amazon and Tesla of their era. The best companies in America, and the valuations got insane. Polaroid traded at 90 times earnings. Xerox at 70 times, Avon at 65 times, Kodak at over 40 times. The logic was the same logic you hear today. These companies are growing so fast and are so dominant that traditional valuation metrics don't apply. Just buy and hold forever. Then reality hit. The 1973 to 74 bear market crushed these stocks. Polaroid fell 90% and never recovered. Xerox fell 70%. Avon fell 85%. Even Coca-Cola, which actually survived and thrived long-term, fell 70% from its peak and took over a decade to recover. Here is the key insight. It didn't matter that some of these companies were genuinely great businesses. Coca-Cola was a phenomenal company, but if you bought it at the peak in 1972, you didn't make your money back until 1985, 13 years of waiting. And that is for a company that actually succeeded. For the ones that failed, Polaroid and Kodak eventually went bankrupt. Investors lost almost everything. This is the danger of paying too much for even great companies. The valuation matters as much as the business quality. And when valuations get extreme, even great businesses become terrible investments. The second major concern is the fundamental deterioration in many growth businesses. The pandemic created artificial demand for many technology companies. People stuck at home bought more things online, used more cloud services, signed up for more subscriptions, played more video games. Companies that benefited from this surge reported extraordinary growth rates, and investors extrapolated those growth rates into the future. But now we're seeing the truth. Much of that growth was pulled forward. Demand was borrowed from the future. And as the world normalizes, these companies are facing much harder comparisons. Growth rates are decelerating rapidly. Some companies are actually shrinking. And managements that got used to easy growth are struggling to adapt. I've been looking at the fundamentals of many popular growth stocks, and the picture is not pretty. Revenue growth that was 30 or 40% is now 5 or 10%. Profit margins are compressing as competition intensifies and efficiency gains become harder to find. Customer acquisition costs are rising as the easy growth disappears, and many companies are still burning cash trying to achieve scale that may never come. The most dangerous situation is companies that grew by losing money. They offered unsustainably low prices or unsustainably high service levels to acquire customers. They subsidized growth with investor capital, and they assumed that once they achieved scale, they could raise prices and become profitable. But in many cases, that assumption was wrong. The customers they acquired weren't loyal. They were just attracted to the subsidized prices. When the subsidies stop, the customers leave. I've seen this pattern destroy many companies over my career. It doesn't matter how fast you are growing if you can't eventually make money serving those customers. And many growth companies today are discovering that the unit economics they assumed don't actually exist. Let me give you a concrete example. Think about the food delivery companies that exploded during the pandemic. Everyone was ordering meals to their homes. Growth was astronomical. These companies were valued at tens of billions of dollars. And the thesis was that once people got used to ordering food online, they'd keep doing it forever. The habit would stick. Scale would bring profitability. But what actually happened? As the pandemic ended, order volumes declined significantly. It turns out people actually like going to restaurants. They don't want to pay a 30% markup to have cold food delivered. And the unit economics never made sense. The delivery drivers needed to be paid fairly. The restaurants needed their cut. The marketing costs to acquire customers were enormous. And the customers, many of them churned as soon as the promotional offers stopped. Some of these companies are still around, but they're worth a fraction of their peak valuations. The story didn't come true. And investors who bought at the top are sitting on massive losses with no clear path to recovery. This same pattern is playing out across dozens of growth companies that were pandemic beneficiaries. The third major concern is the competitive dynamics in many growth industries. When a new market emerges, early movers often achieve strong positions. They grow quickly, they build brands, and investors extrapolate that success into perpetual dominance. But that is not how competition works in the real world. As markets mature, competition intensifies, new entrants emerge, incumbents from adjacent markets move in, technology advantages erode as others catch up, and the profit pools that look so promising get competed away. I've watched this happen repeatedly in technology over my 6 decades. The search engine market was supposed to be diversified with multiple winners. Google won and everyone else became irrelevant. The social media market was supposed to be winner take all with one dominant platform. But TikTok came out of nowhere and challenged the incumbents that everyone thought were untouchable. The streaming market was supposed to be a duopoly at most. Now there are dozens of players fighting for subscribers and none of them are making real money. Many growth stocks today are priced as if they've already won their markets, as if competition doesn't exist, as if technological change won't disrupt them the way they disrupted others. That is a dangerous assumption. The only constant in business is change, and today's winners are often tomorrow's losers. I've been in enough boardrooms and seen enough competitive battles to know that moats are overrated. Everyone talks about moats these days, competitive advantages that protect a business from competition. But most moats are narrower and shallower than investors think. Technology changes. Consumer preferences shift, regulations evolve, new business models emerge. What looks like an insurmountable advantage today can be completely irrelevant tomorrow. Think about BlackBerry. In 2007, they had what looked like an unassailable position in smartphones. Enterprise customers loved them. The security was top-notch. The hardware was excellent. Everyone who was anyone had a BlackBerry, and then the iPhone came along and made all of that irrelevant. The moat that everyone thought was so wide turned out to be nothing. The fourth major concern is the quality of corporate governance and management in many growth companies. This is something I've focused on throughout my career because I've learned how much it matters. The people running companies matter enormously. Their incentives, their skills, their integrity all affect long-term value creation. And I am deeply concerned about what I see in the growth stock universe. Many of these companies have dual-class share structures that entrench management and insulate them from any accountability. Many have boards stacked with friends and allies who won't challenge strategic decisions. Many have compensation structures that reward growth regardless of profitability, encouraging exactly the kind of growth for growth's sake that destroys value. When things are going well, none of this matters. The stock goes up, everyone is happy, and governance problems are ignored. But when things get tough, when difficult decisions need to be made, when management needs to pivot strategy or cut costs, these governance weaknesses become critical. Companies with poor governance tend to make poor decisions under pressure. They protect management at the expense of shareholders. They double down on failing strategies rather than admitting mistakes. I've made a lot of money over my career by finding companies with governance problems, buying stakes, and forcing change. That playbook doesn't work with dual-class structures. If the founder controls the voting shares, there is nothing outside investors can do to influence decisions. You are just along for the ride, hoping management makes good choices, and hope is not an investment strategy. Let me tell you about a situation I encountered years ago that illustrates why governance matters so much. I took a significant position in a company that had a charismatic CEO who was beloved by Wall Street and the financial media. The stock was trading at a premium multiple because everyone believed the CEO could do no wrong. He was on magazine covers. He gave inspiring presentations. Analysts worshipped him. But when I looked at the actual governance, I saw red flags everywhere. The board was filled with the CEO's personal friends. Executive compensation was excessive and poorly structured. Capital allocation decisions made no sense when you looked at the actual returns. And there was no mechanism for shareholders to have any meaningful voice. I tried to engage constructively. I wrote letters. I requested meetings, I suggested changes that would benefit all shareholders, but because I didn't have enough voting power to force change, and because the board was completely in the CEO's pocket, nothing happened. The CEO continued making questionable decisions. The business deteriorated as his strategic errors accumulated, and eventually the stock crashed, losing 70% of its value over 2 years. The lesson I learned is that governance is not just an abstract concern for academics and proxy advisors. It has real financial consequences that show up in real losses, and many growth companies today have governance structures that should concern any serious long-term investor. The fifth major concern is the disconnect between public market valuations and private market reality. Over the past few years, we've seen a massive repricing in private markets. Venture capital-backed companies that were valued at billions of dollars have had to take down rounds at dramatically lower valuations. Some have failed entirely. The easy money that fueled startup valuations has completely dried up, but this repricing hasn't fully flowed through to public markets. Many public growth stocks are still trading at valuations that private investors would never pay today. There is a significant disconnect, and in my experience, these disconnects always resolve. Either private valuations have to come up, or public valuations have to come down. Given what I see in private markets, I think public valuations are more likely to fall. This matters because public markets often follow private market signals with a lag. When private investors start paying lower prices for growth companies, it is usually a leading indicator that public investors will eventually do the same. The smart money moves first. The rest of the market catches up later, often painfully. I've been watching what is happening in the venture capital world very closely. Companies that raised money at $10 billion valuations just 2 years ago are now raising at $2 billion valuations. That is an 80% decline in what sophisticated private investors are willing to pay. Companies that were planning IPOs have shelved those plans indefinitely because they know the public markets won't pay anywhere near their last private valuations. The music has stopped in private markets. Public markets just haven't fully acknowledged it yet. Now let me bring all of this together and explain what I am actually doing with my portfolio. I've been systematically reducing my exposure to growth stocks over the past several quarters. Not because I think these are bad businesses, some of them are extraordinary businesses, but because the valuations don't compensate for the risks. The risk-reward is asymmetric in the wrong direction. There is limited upside from current prices and substantial downside if anything goes wrong. Instead, I am moving toward situations where I see clear value, where there is a margin of safety, where I am getting paid to take risk rather than paying for the privilege of speculation. I am looking at industrial companies trading at single-digit multiples with real assets and real cash flows, companies that make things people need, that have pricing power, that generate consistent earnings regardless of what happens with interest rates or the latest technology fad. I am looking at energy companies that are generating enormous free cash flow but are hated by growth investors who think fossil fuels are going away next year. I am looking at situations where I can influence outcomes through activism, where I can buy undervalued assets and unlock value through operational improvements or strategic changes. This is the kind of investing I've done my entire career. It is not glamorous. It doesn't make for exciting cocktail party conversation, but it works. It has worked for 60 years, and I believe it will continue to work while growth investors are nursing their wounds. Let me tell you what this means for regular investors who are watching their portfolios and wondering what to do. First, be honest about your time horizon. If you are a young investor with decades until retirement, you can probably ride out whatever volatility is coming. You'll have time to recover from any losses. But if you are closer to needing your money, if you are approaching retirement or already retired, you need to think very carefully about your exposure to growth stocks. The potential for extended periods of poor returns is real, and you may not have time to recover second. Understand what you actually own. Many investors bought growth stocks without really understanding the businesses or the valuations. They bought because stocks were going up and they didn't want to miss out. That is not investing, that is speculation. If you can't explain why a company is worth its current price based on actual cash flows and realistic growth assumptions, you don't know what you own. And if you don't know what you own, You won't know what to do when things get difficult. Third, consider your concentration. Many investors have portfolios dominated by a handful of large growth stocks. They think they're diversified because they own different names, but those names are all highly correlated. They all go up together and they all go down together when growth is out of favor, which I believe is coming. Concentrated growth portfolios will suffer disproportionately. Fourth, think about opportunity cost. Every dollar invested in an overvalued growth stock is a dollar not invested somewhere else. And right now, there are genuinely attractive opportunities in parts of the market that growth investors completely ignore: value stocks, dividend stocks, international stocks, small caps. These areas have been left behind in the growth rally, and many offer compelling valuations with reasonable expectations. Fifth, don't confuse a good company with a good investment. This is probably the most common mistake I see. Investors fall in love with businesses. They admire and assume that admiration justifies any price. But price matters, valuation matters. You can buy the best business in the world and still lose money if you pay too much for it. And right now, many investors are paying too much for businesses they admire. Let me share what I think happens from here based on 60 years of watching market cycles. I believe we're in the early stages of a significant rotation away from growth stocks toward value stocks. This rotation could last years, even a decade or more. It won't be linear. There will be rallies in growth stocks that make people think the rotation is over. But the fundamental forces I've described, higher interest rates, multiple compression, competitive pressures, governance problems, these don't resolve quickly. They play out over extended periods. The investors who will do best are those who recognize this shift early and position accordingly, not by panicking or trying to time exact market tops and bottoms, but by gradually shifting exposure from overvalued growth to undervalued value, by taking chips off the table in winners and deploying that capital into situations with better risk reward. I've been through many market cycles. I've seen growth win and I've seen value win. What I've learned is that extremes never last. Markets that go too far in one direction eventually correct. And the growth stock valuations we've seen in recent years are extreme by any historical measure. They will correct. The only questions are when and by how much. Let me share one more story that might help put this in perspective. In 2007, just before the financial crisis, I gave a speech at an investor conference where I warned about the risks building in the financial system. I talked about excessive leverage. I talked about derivatives that nobody understood. I talked about housing prices that made no sense. The audience was polite, but I could tell they thought I was being too negative. The market was hitting new highs. Everyone was making money. Why worry? We all know what happened next. The financial system nearly collapsed. Stocks fell more than 50%. Trillions of dollars in wealth evaporated. And all those people who thought I was too negative, they wish they had listened. I am not saying we're heading for another 2008. That was a unique situation driven by specific factors in the financial system. But I am saying that when someone who has been doing this for 60 years tells you they're getting out of a sector because the risk-reward doesn't make sense, maybe you should pay attention. Maybe you should at least ask yourself whether your own portfolio is positioned for a different environment than the one we've had. I want to close with something important. I am not telling you to sell everything and hide in cash. That is almost never the right answer. I am telling you to be realistic about risks, to understand that growth stocks may not be the sure thing they've seemed like in recent years, to consider whether your portfolio is positioned for a different environment than the one we've had. The best investors I've known over my career share one characteristic. They're survivors. They've figured out how to preserve capital through difficult periods so they can take advantage of opportunities when they arise. They don't ride trends into the ground. They don't assume that what has been working will keep working forever. They adapt. That is what I am doing now. I am adapting to a changed environment. I am reducing risk where risk isn't being adequately compensated. I am looking for opportunities where value is clear and margins of safety exist. I am preparing for a period that could be very challenging for growth investors. The time to prepare is before the storm hits, not after. And based on everything I am seeing, a storm is coming for growth stocks. Let me leave you with one final thought that has guided me throughout my career. The market is not a casino. even though many people treat it like one. The market is a mechanism for transferring wealth from the impatient to the patient, from the emotional to the rational, from those who chase stories to those who understand value. Right now, growth stock investors are chasing stories. They're buying companies based on narratives rather than numbers. They're paying prices that assume everything goes perfectly for the next decade. And they're ignoring the warning signs that have appeared before every major correction in history. I've been patient my entire career. I've waited for the right opportunities. I've avoided the temptation to chase whatever was hot at the moment. And that patience has served me extraordinarily well. It has made me billions of dollars and allowed me to survive and thrive while others blew up. That same patience is telling me now to step aside from growth stocks. Not because I am bearish on America or on innovation, but because the prices are wrong, the risk-reward is upside down. And history suggests that this will not end well for those who ignore the warning signs. You can choose to listen or you can choose to ignore what I am telling you. That is your decision to make. But 20 years from now, when you look back at this moment, I think you'll recognize it as one of those turning points. One of those times when the smart money quietly exited before the crowd realized what was happening. I am exiting now. I hope you'll seriously consider doing the same, because protecting what you have is always more important than reaching for what you might gain. And right now, the reach is too far and the protection is too little. The math simply doesn't work for growth stocks at these valuations. I hope you'll be ready for what is coming.